Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing the green organic Dutchman stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. The green organic Dutchman is a premium organic cannabis manufacturer, wholesaler, and retailer. The company is headquartered in Canada and was founded in 2012. It started trading in 2018 and can be found on the TSX, the pink sheets under ticker that's TGOD.TO, and also on the Deutsche Börse. It raised $115 million during its IPO in May 2018. It has a premium product line. The products are carefully crafted, certified organic, slow cured, hand selected and trimmed. This company is really trying to separate itself from the pack. Their goal is to provide the best quality cannabis out there in the market. They also have a mainstream line designed for a larger audience. This line is for the 26% of users who consume 90% of all the cannabis. This is the first organic brand that addresses the large segment. It also plans to add a 40% hash product to its portfolio, which should be an interesting addition. In March 2019, it conducted a medical test with 200 patients, and with the success of that, in August 2019, it entered the market with one SKU. It has the largest licensed organic facility, which provides the company with economies of scale and premium quality. They benefit from quality products and mass production, so this definitely helps them keep their expenses and costs down. Its hybrid greenhouses provide high quality products due to the advanced humidity, temperature, and environmental controls. Also, it can lower cost with natural light and facility automation. It is more sustainable since it uses living soil, and it's built to LEED certification standards. LEED stands for Leadership in Energy and Environmental Design. It is the most widely used green building rating system in the world. It plans on growing its international revenue with its European hemp CBD business. It is working on getting EU GMP certification to export cannabis globally. EU GMP certification is the highest recognition available by companies in the pharmaceutical space. It stands for European Union Good Manufacturing Practices and details the production, handling, storage, and packaging of cannabis. They plan to start entering Germany, Australia, New Zealand, and Mexico, and eventually US expansion as well. It signed an agreement in 2019 for distribution through a well-established pharmacy chain in Germany. It is planning further agreements throughout this year. It has a 50-50 agreement with a company to enter the medicinal cannabis market in Mexico and also the recreational market in the future, if the recreational market ever becomes legalized. In late 2020, it signed an exclusive supplier agreement for medicinal cannabis products in Australia and New Zealand. The cannabis market in Canada is supposed to grow to $5 billion by 2024. There is much opportunity in their home country, which is where they currently do most of their business. It was a little annoying when I called the phone number on the website and the voice message from the phone company said it is not a working number.
The number you dialed is not a working number. Please check the number and dial again.
So the company sounds like roses and sunshine since we just highlighted their future plans. Let's look at the numbers to get the real information. Let's get started with the model. This is a micro-cap company, 177 million market cap. They're trading at 34 cents a share and they have 527 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have negative free cash flow every year since they're not bringing in much revenue at this point. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's also negative each year. The revenue is a sales for the company, and that grows 13x from 2 million to 26 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The cost of their cannabis products and the cost of labor are the main cost of revenue. Revenue minus cost of revenue gives you your gross profit. That peaked in 2019 because their cost of revenue has gone up a lot since then, from 1.4 million to 19 million. Below gross profit is their operating expenses, and their operating expenses are higher than their gross profit, so they have negative operating income each year. But as they grow their revenue, they'll eventually hit break even. Probably around $100 million, they'll break even on their operating income. They paid $9 million of interest on their debt, which is the most interest they paid in a 12-month period. They have a lot of other income and expenses. These are all asset impairments. An asset impairment is when you decrease the value of an asset on your balance sheet and pass through the loss onto your income statement. So they have pretty big negative net incomes every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. And they also spend a good amount of money in CapEx. They spent over $200 million in 2019. Since they do manufacturing, their CapEx is pretty large because they have to buy real estate and they have to buy a lot of equipment. But over time, their CapEx should get lower. They do have to maintain the equipment, but the initial costs of the items are a lot higher in the beginning. Operating cash flow minus CapEx give you your free cash flow, and that's of course negative every year. They issued $270 million of capital stock in 2018. That's from their IPO. They also issued $25 million in 2019, then $44 million. So they're mainly running their business on capital stock, but they also do take out debt as well. They added $7 million of debt in 2018, then $16 million, then $22 million. When a company has negative operating cash flow, I don't like to see them taking on debt because they have to pay the interest payments on their debt, which means they go further into debt. But I do understand they do need the money to grow the business, and sometimes it's easier to get debt than to issue capital stock. This is the equity section of their balance sheet, and they have $168 million of equity. It looks a little different than US balance sheets, because on US balance sheets, the capital stock number is usually really low, and the additional paid-in capital is higher. I think the $108 million is the cash they received from their IPO. They have negative $400 million of retained earnings. Retained earnings is a sum of all your prior net incomes. So this is not good. That's a pretty big negative. But this is common with newer companies in growth mode. Once they become profitable, it should improve this number. Also, if their equity gets low, they can just issue more capital stock. Because when a company issues capital stock, that increases their cash because they receive cash from selling that stock, which also increases their equity balance. So a company can just keep issuing capital stock to get cash and grow their equity balance. Of course, this does dilute the shareholders, and if they keep issuing stock, the shares may be worthless one day. Let's look at the capital structure. $168 million of equity, $48 million of debt. They're 78% equity, 22% debt. Their net debt is $31 million. So that means they have $17 million of cash on their balance sheet. And their weighted average cost of capital, which is a blend of the cost of equity and debt, is 11.3%. And that's a discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 7. That's $584 million. We discounted these numbers back to today using the weighted average cost of capital. We get a value of the company of $271 million. We divide that by 527 million shares. And we get a calculated stock price of 51 cents. They're trading at 34 cents, so they're trading at a 35% discount. It's a buy according to the model. But it's kind of hard to value a company that has negative free cash flow. So the way I valued them, I looked at their competitors, how big the market is, and their potential in that market. I pretty much just took a guess. They would have about $500 million of revenue by 2027, and they would convert 10% of that revenue into free cash flow. And the prior free cash flows just fed into that $50 million. There's also a chance a larger cannabis company would acquire them if that larger company wanted to get into the organic space. So if that happens, this stock price can go up a lot. This is where the stock has been trading since it IPO'd. So you can see it broke through $8 at one point. Because at this time, a lot of people were buying cannabis stocks. And when this company came out and said they're doing something different, they're an organic cannabis company, a lot of people bought the stock. But once they realized the company wasn't making money and they didn't want to hold the bag, they sold off their stock and drove the price way down. In the past year, the stock hasn't done too bad. It had a big jump. There was a lot of buying and selling at this point. That's when earnings came out. So it got up to about 60 cents a share. Then it came down to 34 cents. A problem this company had that other cannabis companies had, they had a hard time getting funding from banks to buy their facilities or warehouses. Because a lot of banks don't want to lend to companies in the cannabis space. And when those news stories come out, it pushes the price down. And the company invested $500 million into its massive greenhouse in Quebec. And that was a huge drag on their cash flows. They weren't able to afford to own and maintain the property. So they did sell it. Even though they did sell the property, they did a sale and leaseback agreement. That means they sold the property, but now lease it from the current owners. So they're still able to use the property, they just don't have to worry about maintaining it. That's like if you owned a house, but you couldn't afford the mortgage payments. So you sold the house to someone else, maybe got some equity out of the house, and now you rent the house from them, so you pay them a rent payment. So you may save a little money each month by paying rent instead of a mortgage. Also, you don't have to worry about maintaining the house. Like if you need a new roof, you don't have to worry about spending $30,000, $40,000. The owner has to maintain the house, you just have to pay the rent payments. I don't really care if they own the property or not. I'm not investing in this company so they can own properties. I'm investing in this company so they can sell cannabis products and make a profit off of that. They have a really high beta, 2.9, so the stock moves 3 times the market. It's very volatile. The stock has gone down 15% in the past 58 weeks, much worse than the S&P 500, which went up 38%. The 52-week low got all the way down to 21 cents a share, and the high was 65 cents. The stock is trading below its 50-day and 200-day moving average. About 1.5 million shares are traded each day on average the past 3 months. Of the 527 million shares outstanding, 523 million are on float, 22% are held by institutions, and 1.6% of the shares are shorted. This stock has really struggled, down 13% in the past year, 94% in the past 3 years. Analysts are bullish on this stock, projecting their earnings to grow 84%, their revenue to grow 50%, much better than its industry and the market. In the past 5 years, their annual earnings decreased 60%, but in the last year it increased 62%. If you invested $10,000 when this company IPO'd, you'd be really unhappy because you'd be down to $900 today. That's a 91% loss. ETF Managers is the biggest shareholder at 11%, then Murray Asset Management, then Asset Management, then the 2 founders of the company own some stock as well. Let's look at their financial ratios. They have negative net income, so we can't look at the PE. They have a decent price to sales ratio of 6.7. That's better than the market average of 9.4. And they do have a really good price to book at 1.0. Price to book is stock price over book value per share, so they have a good balance sheet. They have negative operating income, so they have negative return on invested capital, negative interest coverage ratio, and negative ROE. They do have a good current ratio at 1.5, so they can cover their current liabilities with their current assets. They also have a good quick ratio. Quick ratio is the same as current ratio, except in current assets you pull out inventory. When you look at their current assets, they have 16 million of cash, 5 million of receivables, 22 million of inventory, and 43 million of assets held for sale. So it seems like they're always selling assets, which is not necessarily a good thing, but we have to trust what they're doing is for the right reasons and to grow the business. So they do seem undercapitalized. They had 58 million of free cash flow in the trailing 12 months, 32 million of working capital, so they're short about $25 million. They may need to take on some debt or equity financing over the next 12 months to run their business. Unless, of course, their free cash flows are a lot higher in 2021 than they were in the trailing 12 months. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 20 companies in the same industry as TGOD. We can't look at their PE ratio, but they are doing better in price to sales and price to book. They're lower in debt than average, and they're a really small company, only 177 million market cap. The average is 6.5 billion. So to summarize, I have them trading at a 35% discount, and this company seems a bit risky. Even though they have a nice niche of organic cannabis, they haven't done too much. They seem to be making a lot of mistakes with their facility, but they are growing their business. They grew their revenue from 2 million to 26 million, and they're trying to make moves in the international market. So I know it does take time for a business to grow. Similar to growing anything like a flower, it just takes time. It doesn't happen overnight. So if you do invest in them and they're successful, you could be rewarded really nicely. But like anything, the greater risk, the greater reward. I rank their free cash flows 1 out of 10, their revenue 5 out of 10, and their ratios 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.